Are you the most hawkish on inflation?
I think that all I've been saying on inflation is there are parts of this price surge that'll moderate used cars prices, lumber prices, but they're also, what we're seeing in our work is we're seeing a broadening of price pressures that are rippling into a broader range of items. Semiconductor shortages first affected used cars. Now they're starting to affect more broadly consumer products. Having said that, our PCE forecast for this year, for year end, is 3.5%. But we think that'll moderate somewhat to somewhere in the neighborhood of 2.4% next year. But that 2.4% next year won't be impacted by extreme number of high items. It'll be price pressures on a much broader range of items. So the only comment I've made is I don't want to label, but I'd like to manage the risk because there is uncertainty and upside risk.
Well, there's uncertainty, and a lot of the inflation that we're seeing was predicted by members of the Fed and the Open Market Committee. So how long is it going to take you to have actual concrete numbers that aren't based on just reopening to know whether you're right or wrong about inflation?
I think this is going to be a dynamic picture, which is I don't actually think there's a date at which this is going to become all of a sudden clear. And the reason I say that, again, I'm hearing from my contacts, some of these pressures are due to reopening. We'll see evidence of that, I would guess, through the fall. But some of them, they tell me, are more persistent, have to do with other secular trends, long-lasting supply-demand imbalances, and those may take longer to resolve.
Today, ADP, 692,000, comes in a bit stronger than expected. Does that tell you anything about the labor market? What do you expect for Friday?
The ADP report is about what we would have expected at the Dallas Fed. We still think there's a substantial number of open jobs, record number of openings on the one hand, but there's still a lot of supply constraints.
You guys have the dual mandate. You want progress on both sides. If we don't get up to near $1 million a month, million jobs a month soon, if labor participation doesn't rise, does that affect your call for maybe an earlier taper?
I think these supply-demand imbalances are likely to persist. And so we've been saying for the last couple of job reports that our expectations for the headline numbers should be a little lower. And why is that? We think there are something like 2.75 million people are now who have said they're retired when they were in the labor force in February of 2020. 1.5 million people have left the workforce because they're caregivers. So the participation rate from those groups, it's very uncertain when they're going to come back. Against that, we've got 9.3 million job openings, and the quits rate is historically high. So I think our own expectations is you may not see the explosive headline numbers, but we're seeing continued improvement, and we expect continued improvement in the labor force.
What are you hearing from people in companies in Texas? Your Dallas Fed manufacturing survey shows 70% of companies say there's a lack of available applicants, 60% of service companies, 76% of retailers.
That's what we're hearing. Across the board, can't find workers at $12 to $15 an hour, can't find mid-skilled workers. General shortage of workers to the point where many of the contacts I talk to are cutting back operating hours, cutting back production runs. They're trying to increase comp, they're offering bonuses, they're doing all sorts of things, but there's a lack of supply.
What about the idea that people are going to be moving from cities to smaller areas or cheaper areas? I mean, you're the man to ask here. The report yesterday that Goldman Sachs, your alma mater, is considering its second biggest headquarters in Dallas.
So you're going to see a continued migration of people and firms to Texas, and you're going to see a continued migration across the country. I think it would be a welcome development if some of these smaller towns saw their population stabilized and began to attract more workers. Pre-pandemic, the issue not in Dallas or Houston, but in smaller towns is they couldn't keep population. So with remote work, that would actually be a welcome development. But for Texas, you're going to see continued flow of people and firms to the state.
Well, your chance to brag on Texas here, because in Michael Lewis's book, Liar's Poker, equities in Dallas was the worst possible assignment a new young financial person would get. What changed?
For the last 20 years, the story of Texas is, again, migration and diversification of the state. The state 25 years ago was very heavily reliant on the oil industry. Today, it's probably 7% of the state's GDP. We've got a vibrant technology sector, logistics, supply chain movements there, and broad diversification of the manufacturing and the service sector. But a lot of it is driven, again, by migration of people and firms over the last 20 years, and that's continuing today.
Well, let me go back to the taper issue. You've warned we could see imbalances, we could see excesses in financial markets if you wait too long. How long is too long? When do you need to if the market consensus is the end of the year, is that about when you should start tapering, or has it got to be sooner?
I would prefer sooner, and I've said the words deliberately vague, sooner rather than later. In the FOMC meeting, I'm very more specific about timing. We still have to continue to make progress, clear that we've weathered the virus, which I think we have, but I think it'll be far healthier to start soon and sooner rather than later. Why? Excess risk-taking, excesses in the housing market, and excesses and imbalances in the overall economy. And I do believe if we take our foot off the accelerator gently now, we'll have more flexibility down the road to avoid more abrupt action or severe actions in the future. I really believe that.
Well, you've said to the markets, we're going to give you a long runway before we announce this. If you move it up, does that shorten that runway? And is the Fed a bit of a prisoner of a taper tantrum fear?
I think the aftermath of this downturn is very different than the aftermath of the Great Recession. 2013, we learned a number of lessons. On the other hand, I think today, I think our adjustment in purchases is likely to go much better. And one of the reasons why I've been out there talking about adjusting purchases is I want it to get out into the market. And I think this debate we're having at the FOMC, some of it publicly, is good, that people are on notice that these adjustments are coming. The only question is when. But I think we'll be far healthier sooner rather than later to begin.
Well, if you begin because you're worried about risks, are you adding a third criteria to the idea of making substantial progress on your twin mandates?
I think that we're going to get to substantial further progress probably sooner, much sooner than I would have expected back 6 months ago when we stated that benchmark. But in addition, the efficacy of these purchases, very important and helpful in 2020, helpful early this year. But right now, we don't have a demand problem. We have more of a supply problem. We have plenty of demand. These purchases are very adept at stimulating demand, but we've got plenty of demand. Our problem is supply, and these purchases are not very effective when you've got a supply issue. And so that's a factor that tells me that as soon as we can get to substantial further progress, we'll be healthier to wean off these purchases.
What's substantial further progress?
For me, it's evidence that we've weathered the pandemic, and I'm watching the Delta variant, and just to confirm that the vaccine is still effective against that, which we still think it is, but I'll be watching it. And then further progress in the jobs market. We're obviously made progress on the inflation front, but I think for my taste, when we stated this objective back in December, I think the SEP for full employment at the end of this year, was about 5%. We're about 5.7% now. We're going to make progress versus that December benchmark. And I would be, and I guess I am saying, I'd be on my front foot in being very ready to take action sooner, because I worry about the efficacy and some of the side effects of these purchases, which I think could create some challenges for us.
Well, the consensus on Wall Street is also that it would be about a year-long process to wind down QE. Is that about right, or do you think that should go faster?
I'm not going to publicly prejudge that. I mean, we have to decide when we announce it, when we start, what the pacing is. Is there any difference between treasuries and mortgage-backed securities in terms of pacing? But I think it should be done gradually. And so that would be my main thought. We'll decide on the exact time frame, but I think the runoff should be gradual.
Well, if you're going to have an inflation problem, it has to be a cycle. It isn't just a one-off set of price increases. What are corporate leaders telling you about what they think is going to happen? They're obviously raising prices now, and some are raising wages, but is that going to continue?
And the first thing that most CEOs I talk to tell me is they don't know. And we spend half our conversation at them asking me my opinion. They don't know. They know that they're having trouble finding workers. They know for many of them, they're about to start with price increases. They don't know whether that's one and done or whether they're going to have a series of price increases. They're very uncertain, and the reason is, I'll give you an example. Semiconductors 6 months ago, most of my contacts in that industry said, I think within 12 months we'll resolve this. What they're telling me now is they think it's more likely that's pushed out another year or year and a half, and the reason why is a lot of the energy transition, electrification of the auto grid, smart devices, systems demand more semiconductors. So while they're rushing to add supply, demand keeps going further up, and they're pushing out the time frame. So they're as uncertain as the rest of us, and they're monitoring it very carefully.
You are the president of the Federal Reserve Bank of the oil patch.
Right.
So I'll have to ask you what you're seeing there. Analysts say companies cut back on drilling, cut back on production, cut back on investment to avoid depressing prices.
Well, they cut back to survive initially. So for last year, remember there was the supply shock, but there was also a demand shock because of COVID. So the industry merged, there were a number of failures, restructurings, job losses. It's a much more streamlined industry today, but the industry is resolute coming out of this, that to the extent they have cash flow, a much smaller percentage will go to drilling, much more of it is going to go to share repurchase and dividends, return of capital. And even though prices have firmed substantially, if we ended last year U.S. production about 11 million barrels a day, we think that's just going to go up very modestly in 2021 because they're sticking to that discipline. So supply, it's going to be tough to increase supply, even if demand rises substantially.
I've only got about 30 seconds left, but some analysts are saying we could see $100 oil again. How does that play into your forecasts?
Well, a lot of it will depend what OPEC does. It'll depend on the Iran deal. The only thing I can tell you is even with higher prices, the industry is going to be much more inclined to return capital than to drill. So they'll increase supply, but it'll be very sticky. And that's why we've talked a lot. The energy transition, we have to be aware of it. We need a healthy fossil fuel industry, even as we're aggressively moving to alternatives.